Welcome. If you're curious about intraday trading in the Indian stock market, you're in the right place. This beginner-friendly guide will walk you through every essential step, from understanding what intraday trading means to executing your very first trade. We'll use simple language, practical examples, and zero jargon. Whether you're completely new to stocks or just want to learn the right way to start, this video will help you build a solid foundation. Let's begin our journey into the fast-paced world of intraday trading, where every minute counts and learning the basics is your first step to success. Intraday trading simply means buying and selling shares within the same trading day. You don't hold any shares overnight. Think of it like visiting a market in the morning, buying vegetables, selling them by afternoon, and going home with your profit. In the stock market, you aim to profit from price movements that happen during the day. Unlike long-term investing, where you hold stocks for months or years, intraday trading is all about quick decisions and active monitoring. It's fast-paced, requires discipline, and comes with higher risk, but also the potential for quick gains if you learn the right approach. It's important to know the difference between intraday trading and long-term investing. Intraday trading focuses on short-term price movements. Your holding period is just hours or even minutes. The goal is to profit from quick changes in stock prices. This approach is high risk and demands constant attention. In contrast, long-term investing means buying shares and holding them for months or years, aiming to benefit from the company's growth over time. It's less stressful, requires less monitoring, and is generally safer for beginners. Both have their place, but intraday trading is best for those ready to learn actively and manage risk. Intraday trading, you make money by buying shares at a lower price and selling them at a higher price within the same day. For example, if you buy 200 shares at Rupee 100 in the morning and sell them at Rupee 105 by afternoon, you earn a profit of Rupee 1000. Traders can also profit when prices fall by short selling first and buying back at a lower price. However, as a beginner, it's best to focus on buying first. Remember, prices change every second, so quick decisions and timing are crucial. But always keep in mind, losses are possible, so risk management is key. Losses are a real part of intraday trading. If the stock you buy drops in price and you sell, you'll make a loss. For instance, buying 200 shares at Rupee 100 and selling at 96 results in an 800 loss. This is why risk management is the most critical skill for any trader. Don't be discouraged, every trader faces losses. The goal is to keep your losses small and your profits larger. We'll cover how to manage risk and protect your capital in detail later, so you can trade smart and avoid big mistakes. Let's understand the basics of the stock market. A stock or share is a small piece of ownership in a company. Companies like Reliance or Infosys raise money by selling shares to the public. In India, the two main stock exchanges are NSE National Stock Exchange and BSE Bombay Stock Exchange, both based in Mumbai. These exchanges are organized markets where buyers and sellers trade shares electronically. For intraday trading, NSE is preferred due to higher liquidity, meaning it's easier to enter and exit trades quickly. Always check the market's direction before trading. Nifty 50 is an important index that tracks the performance of the 50 largest and most liquid companies in India. When people say the market is up or down, they usually mean Nifty 50 has moved. As an intraday trader, always check Nifty 50's direction before making any trade. If Nifty is rising, it's generally a good day to look for buying opportunities. If it's falling, be cautious or avoid buying altogether. The overall market trend often influences individual stocks, so never ignore the index. Knowing the market timings is crucial for intraday traders. The Indian stock market opens at 9:15 a.m. and closes at 3:30 p.m. The first 15 minutes, 9:00–9:15 a.m. are the pre-open session, mainly for price discovery. The main trading happens from 9:15 a.m. to 3:30 p.m. You must close all your trades before 3:20 p.m. otherwise your broker will automatically close them and you might not get the best price. There's no trading on weekends or national holidays. Always plan your trades around these timings to avoid surprise. Before you can start trading, you need to open a demat and trading account. The demat account acts like a digital locker for your shares, while the trading account is used to place buy and sell orders. Most brokers offer both accounts together, and the process is fully online, usually taking 1–3 days. Popular brokers in India include Zerodha, Upstocks, Angel One, and Grower. For beginners, Zerodha and Upstocks are highly recommended for their reliability and user-friendly platforms. Once your account is active, you're ready for the next step. After your trading account is set up, the next step is to add funds. Transfer money from your bank account to your trading account. As a beginner, it's wise to start small. Between 10,000 and Rupee 25,000 is ideal. Never put your entire savings into trading. This approach helps you learn without risking too much. Remember, trading is about building skills and experience, not chasing quick profits with large sums. Once your funds are in place, you're ready to explore the tools you'll need for analysis. Good charting tool is essential for analyzing stocks before you trade. TradingView is the most popular free platform for beginners. Create a free account, search for any NSE stock, and set the chart to 5-minute candles. This will help you spot trends and patterns. While your broker's app may have basic charts, TradingView offers more features and is easier to use for technical analysis. Bookmark important websites like INTRADAY.com for stock data, Trendline.com for screeners, and MoneyControl.com for news. Price chart is the main tool traders use to see how a stock's price has moved over time. The horizontal axis shows time, while the vertical axis shows price. By looking at a chart, you can quickly spot if a stock is trending up, down, or moving sideways. Charts help you make informed decisions instead of guessing. Learning to read charts is the foundation of successful trading, and we'll break down the basics so you can get started with confidence. Sticks are the most popular way to display price information on charts. Each candlestick represents a specific time period, like 5 minutes, and shows 4 key prices: open, high, low, and close. A green candle means the price went up during that period, while a red candle means it went down. Think of it as a tug-of-war between buyers and sellers. The color and shape of each candle tell you who was stronger during that time. Mastering candlesticks is a key skill for every trader. Thin lines above and below the candle body are called wicks or shadows. The upper wick shows how high the price went before sellers pushed it down, while the lower wick shows how low the price dropped before buyers stepped in. A long lower wick after a fall often signals a reversal, as buyers are coming back. Similarly, a long upper wick after a rise can signal that sellers are taking control. Paying attention to wicks helps you spot potential turning points in the market. Certain candlestick patterns give you clues about what might happen next. For example, a doji has a tiny body, showing indecision between buyers and sellers. A hammer with a small body and long lower wick signals buyers stepping in after fall. A shooting star with a small body and long upper wick warns of a possible reversal after a rise. Bullish and bearish engulfing patterns show strong shifts in control. Learning these 6 basic patterns will help you make better trading decisions. Technical indicators are mathematical calculations based on a stock's price and volume history. They appear as lines or panels on your chart and help you answer questions like, is the stock trending? Is it overbought? Is the move supported by volume? As a beginner, stick to a maximum of 3 indicators to avoid confusion. The most useful ones are EMA, exponential moving average, VWAP, volume weighted average price, and RSI, relative strength index. Let's look at each one in detail. EMA is a line on your chart that shows the average price over a set number of periods, giving more weight to recent prices. On a 5-minute chart, use EMA 9 for short-term trends and EMA 21 for medium-term trends. When EMA 9 crosses above EMA 21, it signals a bullish trend, good for buying. When EMA 9 crosses below EMA 21, it signals a bearish trend, time to be cautious or exit. Price above both EMAs means the stock is in an uptrend. Use this tool to spot strong trends and make smarter entries. VWAP is a powerful indicator that shows the average price a stock has traded at throughout the day, weighted by volume. It resets every day at market open. Big institutions use VWAP as a benchmark, so it's a great way to see where the smart money is active. If the price is above VWAP, buyers are in control, look for buying opportunities. If it's below, sellers dominate, be cautious. Price bouncing off VWAP with a green candle is a strong buy signal. Use VWAP to confirm your trades. RSI is a number between 0 and 100 that measures how fast and how much a stock's price has moved recently. If RSI is above 70, the stock is overbought and may reverse down soon, avoid buying at this point. If RSI is below 30, the stock is oversold and may bounce up, watch for buying chances. RSI between 40 and 60 is neutral. When RSI is above 60 and rising, it's a sign of bullish momentum. Use RSI to avoid buying at the top and to spot good entry points. Not every stock is suitable for intraday trading. Focus on highly liquid stocks, those with many buyers and sellers. Nifty 50 stocks are the safest choice for beginners. Pick stocks that actually move at least rupee 10, rupee 50 in a day. Check the 14-day ATR average true range to ensure there's enough movement. Look for stocks with high volume today compared to their 20-day average. News or catalysts like earnings or big contracts can also drive strong moves. Always align your trades with the overall market direction. As a beginner, stick to well-known Nifty 50 stocks like HDFC Bank, Reliance Industries, Infosys, TCS, ICICI Bank, Axis Bank, and SBI. These stocks are highly liquid, have steady price movements, and are less likely to be manipulated. Avoid penny stocks, stocks with very low daily volume, or those you hear about from unreliable sources. For absolute safety, consider trading Nifty BES, an ETF that tracks the Nifty index. Starting with these stocks helps you learn in a safer environment. Every trade has 3 key decisions: entry, exit, and stop loss. Entry is the price where you buy the stock, ideally after a clear signal like a breakout. Stop loss is a preset price where you'll automatically sell if the trade goes against you. This protects you from big losses. Target is the price where you'll book your profit. Always decide your stop loss and target before entering a trade. This discipline is what separates successful traders from gamblers. Key rule in trading is to always aim for a reward that's at least twice your risk, known as a 2:1 reward to risk ratio. For example, if you risk rupee 12 per share, your target should be at least 24 away from your entry price. This way, even if you're right only 40% of the time, you'll still be profitable in the long run. Focusing on this ratio helps you avoid emotional decisions and keeps your trading consistent. Placing a stop-loss order is simple but crucial. On platforms like Zero to Kite, after you buy a stock, immediately place a sell order with the order type set to SLM, stop-loss market. Set your trigger price at your chosen stop-loss level. This ensures that if the price falls rapidly, your order will execute at the best available price, protecting you from bigger losses. Always use SLM, not SLL, to guarantee execution in fast-moving markets. Opening range breakout orb is a simple and effective strategy for beginners. The first 15 minutes of trading set the day's tone. Mark the high and low between 9:15 and 9:30 a.m. When the price breaks out of this range with strong volume, you trade in that direction. This strategy helps you catch big moves early and keeps your trading rules clear and simple. Let's break down the orb steps next. Patience is key. Do not trade in the first 15 minutes after the market opens. Use this time to observe and mark the highest and lowest prices between 9:15 and 9:30 a.m. This range forms the basis for your orb strategy. Rushing into trades early can lead to mistakes, as the market is often volatile right after opening. Waiting helps you avoid false signals and sets you up for better opportunities. In your 5-minute chart, identify the highest and lowest prices between 9:15 and 9:30 a.m. Draw horizontal lines at these levels. This is your opening range. The next move is to watch for the price to break above or below this range. Marking the range visually on your chart helps you stay disciplined and focused, making it easier to spot genuine breakouts. Now watch closely for the price to move above the opening range high, buy signal, or below the opening range low, sell signal. Don't jump in immediately, wait for the breakout candle to close beyond the range. This confirmation reduces the chances of getting caught in a false move. Patience and discipline at this stage are crucial for consistent success. Before entering the trade, check that the breakout candle's volume is at least 1.5 times the average. High volume confirms that big players are participating, making the breakout more reliable. Low volume breakouts are often weak and can reverse quickly. Always use volume as a filter to improve your trade quality and avoid unnecessary risks. Once the breakout candle closes above or below the range with strong volume, enter your trade. For a buy, enter just above the breakout candle's close. For a sell, enter just below. Don't chase the price, wait for confirmation. This approach keeps your entries disciplined and reduces emotional trading. Always be ready to act quickly but calmly. Immediately after entering the trade, set your stop loss. For a buy trade, place your stop loss just below the breakout candle's low. For a sell trade, set it just above the breakout candle's high. This step protects you from unexpected reversals and keeps your risk controlled. Never skip this step. Discipline here is what keeps your losses small and manageable. Decide your target before you enter the trade. Your target should be 1.5 to 2 times the size of the opening range. For example, if the range is rupee 15, your target should be rupee 22, 50 to 30 above your entry price. This ensures you're always aiming for a good reward compared to your risk. Once your target is hit, exit fully or partially, don't get greedy. After entering the trade, monitor it closely. If your stop loss is hit, exit without hesitation. If your target is reached, book your profit. Don't let emotions take over, stick to your plan. Sometimes the market will move quickly and you'll need to react fast. Other times, patience is needed. Following your rules consistently is what leads to long-term success. Let's see a real-world orb example with HDFC Bank. Suppose the opening range high is rupee 1,615 and the low is rupee 1,600. The range is 15. At 10:05 a.m., the price closes above rupee 1,615 with high volume. You enter at rupee 1,617. Set your stop loss at rupee 1,606.11 risk, and your target at 1,639.5, 1.5x range. If you buy 45 shares, your maximum loss is rupee 495, but your potential profit is over 1,000. This shows how the risk-reward ratio works in practice. Risk management is the #1 skill that separates successful traders from those who lose money. Even with the best strategy, one bad trade can wipe out weeks of profits if you don't control your risk. Professionals focus on how much they can afford to lose, not just how much they can make. This mindset keeps you in the game for the long run and protects your capital. Golden rule: never risk more than 1-2% of your total trading capital on a single trade. For example, if you have 50,000, your maximum loss per trade should be rupee 500, rupee 1,000. This protects you from losing too much if you hit a losing streak. Small controlled losses are much easier to recover from than big ones. Stick to this rule to survive and thrive as a trader. For every trade, use a simple formula to calculate how many shares to buy. Quantity equals risk amount, risk per share. For example, if your risk amount is rupee 500 and your risk per share is rupee 12, buy 41 shares. Never decide based on gut feeling or round numbers. This habit protects your capital and keeps your trading consistent, no matter what the market does. Decide on a maximum loss you'll accept in one trading day. Recommended is 3% of your capital. For example, with rupee 50,000, your daily loss limit is rupee 1,500. If you hit this limit, stop trading for the day. This rule prevents one bad day from turning into a disaster and helps you maintain discipline. Remember, the market will always be there tomorrow. Averaging down means buying more shares as the price falls to reduce your average cost. In intraday trading, this is a dangerous habit. If the price moves against you, it usually means your analysis was wrong. Adding more to a losing position multiplies your losses. Instead, exit at your stop loss and move on. Discipline here will save your capital and your confidence. Visualize your capital as a pyramid. The base is your total savings. Never use this for trading. The middle layer is for long-term investments. Only the top layer, a small portion you can afford to lose, should be used for intraday trading. This approach ensures your financial security and keeps your trading stress-free. Always trade with money you can afford to lose. There are a few golden rules every beginner should follow. Always set your stop loss before entering a trade. Never average down. Stop trading after 2 consecutive losses in a day. Never trade to recover losses. This leads to bigger mistakes. Always square off your trades before 3:20 p.m. Trade in the direction of Nifty. Focus on quality over quantity. One good trade is better than 10 random ones. These rules protect you from common beginner mistakes. After every trade, write down your entry price, exit price, stop loss, reason for entering, what happened, and what you learned. Reviewing your trades weekly will teach you more than any book. This habit helps you spot patterns in your behavior, improve your strategy, and avoid repeating mistakes. Journaling is a powerful tool for growth and self-improvement in trading. Begin your trading journey with the smallest possible quantities for your first 3 months. Use 10,000 capital and trade 10-20 shares per trade. The goal is to learn, not to make big profits right away. As you gain experience and confidence, you can gradually increase your position size. Starting small protects your capital and helps you build skills without pressure. Above all else, protect your capital. If you preserve your money during the learning phase, you'll still have funds to trade when you've developed skill. Many traders lose their capital before they learn what works. Capital is your ticket to keep playing the game. Make protection your top priority, and profits will follow as your skills grow. Here's a quick recap. Trade between 10:15 and 12:30 p.m. and 1:30 p.m. 3:00 p.m. Risk only 1-2% per trade with a daily max loss of 3%. Always aim for a 2-1 reward to risk ratio. Use only EMA 9 and 21, VWAP and RSI 14 as indicators. Limit yourself to 1-2 trades per day. Square off all trades by 3:15 p.m. Avoid trading on F&O expiry days, budget day or RBI policy day. Start with Rupee 10, 000, Rupee 25, 000, money you can afford to lose. Stick to these basics and you'll build a strong foundation for your trading journey.